Hey, Mad Money fans, check the bottom of your screen for an exclusive offer. Next.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll want to make friends. I'm just trying to make a little money. My job is not just to entertain, but to teach, and I'm telling you, I'm going to do a lot of teaching tonight. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Tough days do not last forever. But when they come along, you need to know how to respond. You need a game plan ready so you can figure out what kind of sell-off we're dealing with and then react appropriately. Because the early days of a decline are never easy to navigate. You need all the help you can get. To borrow a line from Tolstoy's fantastic Anna Karenina, all happy rallies are alike. Each sell-off is unhappy in its own way. It's true. Bull markets send stocks higher, and everyone thinks they're a genius participating because it seems so darn easy. Same every time. But big declines, much harder. They could be the start of a bear market, or maybe something worse. Or they might actually be just a buyable glitch. That's why tonight we're turning to history to illustrate some of the common qualities of sell-offs, so you know what to do the next time the market has an inevitable moment of weakness. Now, really, there have only been two truly horrifying sell-offs since I started investing over 4 decades ago. The one-day crash of 1987 and the rolling crash of 2007 to 2009. That was the financial crisis. Do you know what? Even the COVID crash, when the S&P 500 lost 35% of its value in just over a month, that wasn't nearly as bad as these two, especially when you remember that the market started rebounding almost immediately. So let's deal with the two big ones head on, because they make for great examples. 1987 and the financial crisis are actually polar opposites, although the percentage declines were really pretty similar. On October 19, 1987, also known as Black Monday, the Dow Jones Industrial Average fell 508 points, or more than 22% in a single session. I was trading that day, and even as the previous week had been one of the worst weeks in market history, Black Monday hit fast and hit hard. It felt there were no buyers to be found from Dow 2,246, where the crash started, to Dow 1,738, where at last it ended that day. It kept tumbling right into the close. I remember thinking, saved by the bell, except it felt like there wasn't that much money left to be saved. But most people don't remember that the week before was horrendous, too. The Dow had already plunged from 2,482 to 2,246. That's nearly a 10% decline. That harsh pullback encouraged bargain hunters, intrepid souls who thought they could flip into in Monday morning into some strength. You bought Friday, flipped it on Monday, except the strength never showed up, and they got badly burned. In fact, the weakness continued into the next day. That day became known as Terrible Tuesday, where the Dow kind of just broke down entirely. The market simply stopped functioning. But you know what? I was there. And I was actually able to calculate that bottom. The bottom turned out to be about Dow 1400. That was down another 122 points, or about 7% from where we closed on Black Monday at the end of the day. It was all just, I pieced them together one by one. And people didn't think it ever went down below Dow 1600, but they were wrong. Then Fed Chairman Alan Greenspan stopped the decline in his tracks when he said he'd provide all the liquidity necessary to stabilize the market. Now, I still remember that green line when it came over your screen. He enlisted multiple firms around Wall Street to help put in the bottom, and the market staged a remarkable 2-day rally that took the Dow up more than 400 points from its lows. It seemed pretty unbelievable at the time. The effects of the crash lasted for just 3 months when we had a retest that held. But do you know that it took until mid-1989 for the averages to return to where they were trading before this big breakdown? The bear market that began in October of 2007 was a totally different animal. Dow fell from 1,198, so it was at 14,000. Remember, the other one was at 2,000, 14,000. And it didn't bottom until March 6th of 2009, when it landed at a staggering 6,470. We didn't return to that hallowed 2007 level until March of 2013. Why did one sell-off end so quickly while the other took 6 years to unwind? Well, that's the question that defines the two extremes of unhappy sell-offs. See, Black Monday was a mechanical sell-off, the first one I can remember where the averages melted down because of pure market dysfunction. It's instructive to unpack Black Monday because the way it played out was reminiscent of 2 other crashes, the flash crash of 2010 and its doppelganger in 2015, both times when the market simply failed to work. Now, all three of these started with the S&P 500 futures pits in Chicago. See, Chicago overwhelmed Wall Street in New York, where the stocks underneath the futures are traded. Black Monday happened because stock traders didn't understand the power of the futures market back then, which could flood the stock market with instant, unseen supply. No one was ready for it. These days, we accept the futures are worth watching, but it wasn't like it back then because they were relatively new instruments created about 5 years before the crash, and no one knew the power they had. See, the power of the futures snuck up on us, as they were initially a much smaller market than the stocks themselves. Because portfolio managers could go in easily and out easily, though, the futures became the most powerful drivers of stock prices, particularly for hedge funds, even more powerful than the actual performance of the underlying companies that stocks are meant to represent. Underlying corporate earnings used to mean much more to the day-to-day action of a stock. The thing is, even with the relatively new impact of futures, Black Monday was highly unusual. We'd had a big run going into the crash of '87. It was a remarkable multi-year rally with nary a substantial decline. And don't I know it? I left Goldman Sachs in 1987 to start my own hedge fund because my returns had been so bountiful for investors. The multi-year rally in the mid to late 80s had created such stupendous gains that a group of clever salespeople started offering big funds what they claimed were insurance policies that could lock in gains and stop out losses after their funds had gone up so much. So-called portfolio insurance involves something called dynamic hedging, where these specialists said they could use futures to ensure that you'd no longer be exposed to stock market risk, say down 5 or 10%, or some other number depending on the policy you took out. Yeah, it was like a stop loss. The idea was that these policies would let you sidestep the losses. Of course, it's impossible to do that, but they had such a great sales pitch. People believed them because the stock futures were so novel. In reality, though, when the losses all kicked in at once on Black Monday, the portfolio insurance didn't work. If anything, the futures selling from these insurance policies actually accelerated the decline in the stock market, causing massive losses for the poor saps who bought these things. Many of the actual clients were wiped out. The people who sold these policies, they were charlatans and mountebanks, although history remembers them as just really as idiots, not the crooks I thought they were. I lean toward the latter theory because there's no magic trick that can get you returns from investing in the stock market without much risk. Come on. The two go hand in hand. Don't believe anyone who tells you different. Those people are charlatans. Of course, at the time, we didn't know that the power of the futures could cause a crash. We figured where there's smoke, there's fire. If the markets crashed, then there's going to be something wrong with the economy, right? Simply had to be a recession lurking. The stocks couldn't go down on their own. There had to. Otherwise, how could the Dow plummet 22% in a single day after falling 10% the week before? I say, though, it turned out wrong. The economy was strong going into the '87 crash, and it was strong coming out of it. There just wasn't any economic correlation with Black Monday at all. It was the interplay between Chicago, much more powerful than realized, and New York, much weaker, that set up the conflagration. And when the Treasury Department examined what happened that day, it concluded the futures set off immense selling, while some specialist firms on the floor of the exchange and some brokerage houses failed to step up in what's known as stabilize the tape. The latter had no duty to stabilize things, but the former were supposed to do so. The Treasury found out that many didn't do their jobs. Now, I was fortunate enough to actually be in cash on Black Monday, having liquidated my portfolio early in the previous week because the market acted so badly. I didn't want any part of it. Now, in retrospect, it did make my career. I look like a true genius. But the truth is, I was just frightened of the market and wanted to regroup. I always say, though, it's better to be lucky than good, but discipline can help maximize your luck, which is why we spend so much time teaching you discipline in the CNBC Investing Club. So here's the bottom line. Sometimes crashes have nothing to do with the economy. They're caused by the mechanics of the market. Stay tuned for more examples of this kind of decline and the more serious animal, the bear market of 2007, 2009, so you can figure out what to do when they really maul us. Irma in New York. Irma.
Yes, good evening, Mr. Cramer.
Good evening.
I'm planning to open Roth, non-deductible Roth IRAs for my grandchildren who are all in their 20s.
Okay.
Am I better off with a growth fund or an index fund?
I want you to be in growth because they're young. You can switch to index in the 30s. But let's go for some real risk here because they got their whole life ahead of them, and I really want you to hit it big right now for them. Tony, I am alone in that, but I don't care. I really want risk taken when they're younger. Tony in Florida. Tony.
Hey, Jim, I just want to let you know I'm a member from day one and will be a lifetime member. I love you for your thing. What I want to ask you is when we like a stock or love a stock and it reports earnings that are really good, but then for some reason the market buys it down, can we buy it day one, or do we have to use that rule like everybody says, wait 3 days before you buy a stock that goes down?
No. You buy it at your prices. You buy a little bit at the beginning, and then, like we teach at the club, you buy it on the way down. We may have a real battle on our hands now. You know we battle in the club, and we've been very successful in most of our battles. Some of them have been tougher. But that's the way you make it so that your battle won't be too hard. Buying it all at once does that, and we don't want that. Tough days don't last forever, people, but when they come along, you need to know how to respond. On Mad Tonight, I'm giving you a crash course in crashes, sell-offs, pullbacks, and big market declines, so you'll be prepared to get the best possible outcome from the worst possible situations. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.